Same Tom and same Chris, another podcast. Chris, how you doing?
Doing great, Tom. How you doing, man?
Okay. I mean, gosh, here we are, end of September. End of September. We're getting a change in the leaves. Autumn is here. Although as bad as it's looking right now for a September in the stock market, this is, I mean, the best time to lean into something. We've said it before, is when chaos is going on.
Yep.
I want to talk about, well, we got it down at the bottom. We're going to talk about Apple today. We're going to talk about Apple. We'll give a consensus for a long-term forecast on Apple and 3 different ways you can trade it. But before we get into that, I would be remiss if we didn't focus on the month that is closing up right now, Chris. I mean, I'm going to throw a chart up, and you know what? I'm going to do it right now. I want to show everybody what it is you and I started talking about before we went live. And so let me just go ahead and share a screen. And this is, here we go. So that's the S&P 500. This is 110 days on the chart. I went back 110 days, Chris, because if you look all the way back here into April, and let me blow up April here real quick. Here's April. Here's the support. The last time we had a virgin support territory was around 405. Okay. Yep. Now that's a 30-day moving average we see on here. It's a short term. I'm using it for something else. But the most important thing here is that if I actually throw on some fib levels and bring this up again, here you go. I mean, check this out. It's from that low to high that happened from April, the end of April to the end of August, the pullback we had, it took us into a Fibonacci retracement area, but look where we are coming into the end of the week. 420, 477, like 425, which is a really interesting area. Could this be it as we're at the end of September?
Well, you know what? First of all, let me say, Tom, that I'm going to pat both of ourselves on the back here because 3-4 weeks ago, we pulled out your money calendar, we pulled out my seasonality data, and we nailed this thing. I mean, it's always good to feel like seasonality is one of those things that can happen or not happen. And this has played out perfectly. But when I look at the chart here, that 420 area looks like we could see some support. But really down at that 400, 405 level is where you start to play around with that 200-day moving average. You know how much the media likes to talk about the 200-day moving average. It's as if that's the only trend line they watch. So while I think we could squeeze a little bit lower here, a little bit lower, and we're almost to that sweet spot in seasonality. October turns around. What do you think about that 405, the 200-day? You've got the Fibonacci right now, the 61.8 that we'd be going through at the 424. What's your thoughts on that 404, 405?
Well, I like this part, right? I like where we are right now because the season is going to change. It should be starting to change right now, going into October. So, as long as I keep hearing what a big deal, what a problem everything is out there in mass media, then I got to think this might be a great place to start backing up the truck.
Yep.
And I'm not talking about backing up a dump truck. I'm talking about backing up in a Suzu.
My Toyota Tacoma.
Many pickups that we might have to back up. But and what I'm talking about is slowly dipping our toes into the buy side of this market. There are 3 areas right here. Chris, you'd mentioned them. That's the area we're at right now. Okay, that's the 61.8% retracement level. There's the area on the 200-day moving average. If we want to go with all mass media, that's around 420, 415, 420. And then there's that 405 level, which is the lows back in April that we've got on the screen. So, I mean, those are 3 good areas that we could lean into on this market. But, I gotta say, I like the seasonality going in because we did pick this to the downside. Where we see if we're really right is if we start to move higher from right now. Because if we don't, then maybe seasonality isn't going to kick in because of these higher interest rates. Maybe seasonality isn't going to kick in because of some of the things that are perceived in the mind of investors, like, for instance, the UAW strike,
which
is now expanded. you know, and then you look at, I mean, there's kind of a perfect storm going on that might make this a little tougher than before. You've got the ongoing strike. Okay, that's an issue. I think they're talking about solving the writers' strike.
As I read last night, that appears to be a done deal. It's going to a vote of the union. So,
But I
yeah.
mean, they've been on strike since May. Could you imagine if the United Auto Workers strike stays on until for 5 months? I mean,
You
if
know what?
that's the case, that
Frankly, Tom, I think they'd be doing Ford and GM a little bit of a favor because they've got inventory stacking up anyway. So
they do. But you know what? To be on for 5 months, I mean, the only company I think that benefits is Tesla, the non-union
correct,
company.
correct.
You know, and even Elon Musk made some comments earlier in the week, and it was kind of warning. He was warning the UAW. There's been two people that have been outspoken about the strike, and that was Elon Musk and Donald Trump,
Correct.
who said you're killing yourselves. You guys got to realize that both of them said there's negative equity. There's negative profit margins if the strike continues. And
Musk was
how can you expect a 40% raise? I mean, I get it. These guys were taking money and they were doing really well during the pandemic and coming out of the pandemic. And I think part of that was also a chip shortage. But you're right, they overproduced, and now you've got a strike that's going to slow things down. But don't you think that also hurts the American consumer if this strike leads on? Because all of a sudden, you know, if they have to compete against Tesla, where are they going to make this money up? I got an answer: combustibles.
That's the only place.
Engine, that combustible model is going to go up in price. You know, at the same time when you got gas prices at highs, I think for the year, there's just a lot I think that could cause a little bit more pain in the consumer. And you know, the worst tax in the world, CJ, I think we said this before. The worst tax on America is at the pump,
fuel,
and then the second worst tax is is your purchasing power.
Yeah.
So
I just did some napkin math here, Tom, and they say 60% of a vehicle's cost is labor, right? That's usually the number you'll hear.
And the other and 25% is the paint job.
Yeah. See, yeah, exactly.
Scares me.
So if that 60% is true, a $50,000 car, $30,000 of that is labor. After a 38% increase in labor cost, if they get that through, that'll go up to $41,400. So your $50,000 car now turns into a $61,400 car thanks to that increase in labor. That is because GM and Ford will pass that right on to you and I. They are.
Oh yeah.
They can't afford to take that on. And remember, that's for a 32-hour work week instead of a 40, which has been proposed as part of that 38% increase. That's mind-numbing in terms of what we'll actually be paying.
I'm gonna end on this, and then we're gonna get into Apple. So, Chris, I don't know if you know this. In the first time in my entire life, I decided to buy a vehicle online, custom order a brand new car.
Okay.
Never done that before. Okay. I mean, I've stayed away from my first new vehicle was about 5 years ago because I just used it to get from A to B. Right. Now I need something, and it's a pickup truck. I got several cars, but I gotta say the pickup truck has been the one I get in the most because I use it for everything. So I'm like, wow, I'm getting another pickup truck, but this time I'm gonna get what I want. Right. And so, no discounts this time. That kind of upsets me. I can't, because I'm getting something custom made, and then I'm upfitting it on top of that. Okay. And an upfit is where it goes from the dealership, or it goes from the manufacturer to the dealer, and the dealer's actually upfitting it with some extra stuff.
Okay.
Needless to say, I was worried because I was watching it. I'm getting updates on it being built, and I'm like, oh no. It's going to get stuck in the middle of the assembly line. Oh. And I found out that my truck's being built in Mexico. This is, I mean, now I'm all for American made, But all of a sudden this time I'm like, man, my vehicle's getting no, it's done. I just got yesterday an email that said the truck is done. It's now going to the upfitter. The dealer's not going on strike.
Wow.
The dealer is actually going to have, in fact, I think it might be done a little bit early, because if the dealerships are not as busy, bringing in new inventory as they were,
right.
I mean, what are they going to do? They're going to satisfy the customers they have with oil changes and fixing problems here and there. They might have a little bit more time to get my upfit done. But
right.
I'm bringing it up because here's the big reason I'm bringing it up. If this strike holds out in the next year, like you said, the price of automobiles or new vehicles is going up.
Yep.
I already paid for mine. So maybe I did get a discount and I didn't even know it, in terms of getting that order in well before the strike.
There you go.
Possibility. Anyway,
I like that.
Yeah, we'll see what happens. Hey, let's take a bite of the Big Apple. And the Big Apple I'm talking about, folks, is not New York City. It is Apple stock. We talked about it last week. Want to get into it and dive into it for the rest of the podcast. We're going to talk about the company itself. We're going to talk about the last 100 days on the chart and why it looks so interesting to us today. And then 3 ways you can take a bite if you're a bull. So let's start with the company. You got anything to say other than the fact that last week they announced, was it last week? It was 2 weeks ago. They had the big reveal. And I'm going to tell you, Chris, I have not pulled the trigger and bought an iPhone 15. And the reason why is I'm looking at my 14 and I'm thinking to myself, how much more does the 15 offer than the 14, other than a faster processor, which I'm happy with the 14, maybe a little bit better camera. And I mean, that's not going to make me take pictures of my receipts that much better, because that's what most of my pictures are pictures of receipts.
Right.
For accounting purposes. And titanium?
Yeah.
I put a cover on I put a cover on my phone. This is the cover that's on my phone right now. See? And it opens, and I got my cards, and there's my driver's license. I mean, I use this thing as a wallet. I
am one of those people, Tom, that lives on the edge. I have like the Gorilla Glass on there, or the glass protector, and that's it. No cover, nothing. I can't. It
slips in and out of your pocket easier, doesn't it?
It sure does. And the glass has caught 100% of the damage, and you just switch it out. It's $10 each time I do it. At one point, I'll get unlucky and it'll bounce off a corner, and that'll be the end of it. But I think I'm 3 years on this phone, and not a problem.
I came up with a great business idea for you.
Go.
For the weekend. You can go to the kiosks at the mall. They got them all.
Yeah.
And somebody needs to start ceramic coating these the glass like they ceramic coat cars.
Okay.
You can make a heck of a business ceramic coating the glass on an iPhone to where, and all of a sudden now I think it has like 3 times. It may actually have 3 times the hardness strength. Just putting a ceramic coat or 2 on them. It's just an idea. I know you don't have anything to do on the weekend, so
Yeah, exactly.
There you go. All right, so looking at the iPhone sales, we talked about this. What are you seeing in terms of? I mean, there's things I love about Apple, but these product releases, it's newer, it's better, it's the phone. It's like they say it every year, and it has some differences on it, but at the end of the day, when you talk about it being the best thing since sliced bread every single year, even sliced bread starts to look a little stale.
Yeah. You know what? When it comes to the equipment, the phone, the watch I'm sold on, and I know you are too, I go over here and literally, look at that, Tom. This is where the iPhones go to die. There's a 3. I mean, that's a 3. And I think I'd prefer using this right now.
I have the first one somewhere in my stash. Right. I got it's all white. It's all white, and I thought about making a big, framing it and then sticking it inside the frame. The generations that I have.
Yeah, this is a great hard drive now. But the difference between this and this, is that this is a better conduit to what Apple is, and that is a service company. They're not really a hardware company anymore. They generate $1 trillion or trillions of dollars as a service company and not
Yeah.
the cell phone service company. It's everything that we buy, it's all the subscriptions. So that's what I look at when I look at this and say, do I like this enough that I think the company's going to go to $500? The answer is no. I think that they're being caught up by Google and everybody else out there. Samsung makes some good products, but the service that comes behind this, the service that this gets me, is the thing that they are making trillions off of. And that's why I do think that on an opportunity when it drops 20%, 15%, people are wise to look at this as almost that annuity out there on Wall Street. I hate to put it that way because annuities are guaranteed, and we know we don't guarantee anything that we recommend here, but that's what it is, Tom, isn't it? I mean, it really is kind of an annuity.
Yeah. Quick fundamentals. I mean, this is a $2.6 trillion company right now.
Mm-hmm.
I remember when we were all talking about it passing the $1 trillion mark. There's still only a handful of companies that are above $1 trillion market cap. The PE ratio on this one, if we want to get all fundamental for a few minutes, is near 29. So
20.
It's still a tad expensive, but I'm with you. You know what's going to power this company in the future is its services. The biggest thing that got me excited about Apple a couple weeks ago wasn't the release of the iPhone. It was increasing the services for storage. They're going up to what is it? 3 and 6 terabyte. I think that's what I heard. 3 and 6 terabyte plans, and there are people that have that much storage just in pictures that they need the storage for. And so this is the kind of stuff that excites me. The fact that they're renting out their cloud space. They are the public storage of all things digital, if you will. Yeah. And so that's a big deal. All right. So let's flip forward and get into the technicals. So let's bring up a chart. Let me bring up another chart of Apple. There we go. There's your chart of Apple. This is a 100-day chart. Take a look at this, Chris. You can see here, you've got Fibonacci charts going back, and you see this low. This is 171.56 right now, or it's really around 171. All right, you want to round it down to 170, great. But this was back before Memorial Day. We had that nice big summer run that took us up to the beginning of August. Then we had earnings come out and a big kibosh that took us down in 2 weeks. We went from 196 down to around 172. Right, moved up a bit, but look what's happened here. This is Apple in this area right here. This is the stock market too, folks. Right there. This is the month of September. So so goes Apple, so goes the market. We're sitting down here as we head to the end, as we're in the end of September, we're sitting down into these Fibonacci low areas. This is an excellent area as we end the month. And we also end the seasonality, the bearish seasonal move, that possibly this is a good area to pick this up. CJ, talk to me about your technicals.
My technicals right now, I'm going to look at the number that the entire market will be focused on, and that is the 200-day moving average, which is right around that 165, 166 level. 170, and when we talked a couple weeks about that, you had that wonky little, it doesn't look like a traditional. You've got it right there, though, Tom. A head and shoulders after the stock had declined after earnings. You got that left-hand shoulder right there by your arrow. Then you got the head that popped up, and you got a neckline that was right at 175. We broke through that, and it looks as though we could just get a little bit of a dip maybe here in this last step of seasonality that could take us down around that, maybe just a little one below that 170. So I like looking at it for that 166 or so. That's where I look at this stock and say, you know what, even if I'm wrong and it goes down another 5%, I am happy buying it at that 165 level, because you know what? That is about, at that point, you're 15% off of the highs that we just posted 2 months ago or a month and a half ago. I'll take that deal right now. 15%.
Let's check this out. 150 days back. Takes us down to 145. Let's go 175. And I'm bringing this up, folks, because I want to see the real pullback. All right. That looks like a fairly significant pullback right there after earnings that happened, the Q1 earnings that happened there back in March. And so you can see here, we went from about 155 down to close to 140. So if that is the real bounce there, we can kind of take this back to that 150-day chart. Okay. If that shows us the 140 low, and it almost does, I mean, let's just snap a Fibonacci chart on this and see where we sit right now. Look where we sit.
Ooh.
50% retracement, 170.88. There's your 61. And look at that, right around the 200-day moving average.
Yep.
So there's a lot of contrarian indicators, or what we like to call bump stop indicators here, where we could bump and stop where we are right now. We could bump and stop another 5 points lower. And those all make good entry points. So let's cut to the chase, CJ.
Let's trade it. Yeah.
Like this stock. If you like it where it is right now, or maybe you see it a little bit lower, what do? First, let me start. I'll let you take the next one and I'll finish it up. So you could just buy the stock. And so let me ask you a question, CJ. Where do you see the stock this time next year?
Man, let's go to the end of the year. I always like to make those targets at the end of the year.
Yeah.
I think you take 200 out. I think we rally back up to 200 and then just give Apple, election year, all of those things. Maybe we get a little tailwind, give it a 20% bump next year. You end up at 240, December 31st, 2024. That's where I think we could end up.
So that's a nice 20% move on the stock. All right. So that's, for every dollar invested, you get $1.20 out of it next year. If you decide to get rid of it next year at that time frame, at least here in the States, you got long-term capital gains you have to deal with. So you make 20% and you giveth 20%.
20%.
Do you really make 16?
Remember Boss Hogg and Roscoe P. Coltrane, 50% of 50%, boss.
That's right. That's right.
20%.
So I mean, so do you really get 16? You really get 16% on a net. I mean, we could dilly dally in that all day long. But so buying the stock, you see a 20% upside. All right. So let's talk about two different option strategies, and the one I want to talk about with you first is buying calls, and not just buying any calls, but what calls are you interested in right now, CJ?
I like the leaps. I like the leaps here. Those listeners, viewers that don't know about a leap, it is just a longer term expiration option. The leaps that I'm looking at expire in, get this, Tom, January of 2026. So
January 16th of 2026.
Yes.
That's my brother's birthday.
There you go. That's
And
my daughter's birthday too. Yeah.
Wow. He's gonna pass mid-50s.
My daughter's not so far along, but yeah. So that option gives you the right to buy the stock. And in this case, I've looked at the 180 strike. So it's a little more than 10-15% out of the money right now. If we hit that 165, I'm looking at.
Yeah.
But that's because I expect the stock to come back up and go over to that 240 that I talked about. And that's not even before expiration of this option. You'd still have a year left on this option at that point, the end of next year. So I like that, Tom, because it gives me a couple of things.
You have 800. There, check this out. You have 843 days remaining before expiration today.
Yep.
That's a lot of time. And so we're looking at the call options, folks. Here's the 180 calls. Couple significant things about them, real quick. First of all, they're going to cost about $31.
Yep,
roughly $31, $32. The next thing is that I've got some colors in here, and these are kind of interesting colors, and I'll explain them to you and the audience. That blue we're looking at tells me that this is the lowest implied volatility option in the chain we're looking at right now, as far as all calls that are slightly in and slightly out of the money. This is a slightly out of the money call option. So that tells us that if we're looking at which ones to buy versus, depending on volatility, this is the right one, CJ. The other thing I'm going to mention is, and we're 843 days away, so not a lot of people are looking at these leaps.
No.
But who is, well, most of them are looking at the 180 calls because, yesterday we had 115 of volume and we had 274 open interest. So somebody's interested in these, CJ. Did you buy calls on this recently? You got your hand up.
I haven't bought them because we were talking about them today. I will tell everybody, you, Tom, and myself, we don't recommend something or we don't buy something and then recommend it so the price goes up. We always wait until we talk about it in a forum like this and then we buy it. But I'll tell you something, there'll be a number there tomorrow that'll represent me. So
okay, there we go. All right, so that's the 180 calls. They expire January 16th, 2026. You don't have to hold on to them that long. When you buy a call option, folks, you have the right to purchase the stock at 180. And if it comes around, you want to get out of these things. You have a target, that target of 2024. So there's still going to be over a year. At the end of 2024, you've still got 2025 and part of 2026 to get through.
Right.
So it's still going to be more than a year to expiration. Let me just show everybody what this looks like on a risk graph. So this is a risk graph right here. This is Apple stock, all right, going back to May. And there's those support points once again. And here's where we are now. And what this basically shows me is this is where we are on the graph right now. If we were able to pick these up for $31, so they're going to cost $3,100 per contract. So instead of buying the stock for $170 per share, you have the right to buy it at 180, but it's only going to cost you $31. So you're talking about hedging off over 95% of the cost and the risk on Apple between now and January 2026. That red line also tells us if Apple goes back up, let's say it pops back up to that 196 level over here, I can come across, CJ, and I can see that my theoretical profit is going to be somewhere getting pretty, close to around 18. That looks like, about $1,800 of profit potential. That's great. Now that's if it happens in the next couple of days. But let's say, you give yourself 100 days or so, or even 150. You still, if it moves back up to that area that was just before the earnings, you're still looking at over $1,000 of theoretical profit. Now you're talking about this thing going up to 240. So I ran the theoretical numbers. I put 240 in here, and all I got to do is move my mouse across here. And if we were looking at, like you said, a year-end expiration date, we're probably looking at somewhere around, I would say we're probably looking at somewhere around $3,500, $3,600 in theoretical profit. If we hold this thing all the way out to the end of next year, and it does go to 240.
Yep.
But here's the guarantee, because we can't guarantee any of that. The only guarantee I see here is that you can't lose more than you put into this trade. I mean, the worst that this thing could do is you buy it, you fall asleep, and you wake up January 16th, 2026, and you only lose $3,100. If you follow your rule and you get out, and let's say the stock drops to 130, you're really only going to be out about not 3,100, but you'll be out maybe about $2,000 or $2,500 on this trade, because you still have all that time left over, and time is worth something to someone. All right. So there you go. The benefits of a call option: limited risk. You got some really huge upside potential, and you have an ROI that, if the stock does what you expect it to, is going to give you close to 100% return on the options versus a 20% return on the stock.
That's right.
All right, I'm going to say real quick, another thing we could do here is we could sell the put options. Now, that obligates us. This is completely different, folks. Still bullish. If I sell the open put options, it obligates me to purchase the stock at said strike price, but I'm getting premium for that. A conservative trade would be to look at, for instance, I'm looking at the December 2024 options. Taking a look at, I don't want to buy a 2020, I don't want to sell a 2026 option if my plan is to get out of it, or to have it, my target be 2024. That's about a year, a little bit more than a year difference between when I'm seeing a target and when the expiration is. If I'm selling time, I want time to chug into my side as soon as possible. Correct. I can get about $15 if I sold the December 20th, 2024. Okay, a little more than a year from now, a year and 2 months. So if I sold the December 20th, 2024, 170s, these are slightly out of the money, 170 puts, I can collect about $15 for those right now. And that $15 means I'm putting $1,500 in my pocket for every contract I sell. Now, for every contract I sell, also, I'm obligated to buy the stock at 170. Where's my break even? 170 minus the $15 per share that I bring in to obligate myself at 170, and my break even is 155. Okay. We know where 155 was. You got to go back 150 days to see the 155 number. If you believe that 155 is a fantastic price to break even on Apple, then this might be something worth taking a look at, folks.
Yeah.
Right? That's selling the put option. And that brings in, by the way, all you got to do is CJ doesn't even have to be right. Okay. We could go sideways. And you'll pocket that money. If we're at or above 170 by December 20th, you're pocketing that money. That's a 9.68% return on the stock right now, which is about almost double what Robinhood's paying you to put the money in cash and have it sit in your account. Now, completely different. We're talking about, that 4.9% Robinhood. I'm not going to say it's risk-free because that number could change too.
Right.
But it's going to be a lot less riskier than putting your money into a short put on Apple. But if you like Apple at this price and you think it's just maybe going to go sideways over the next month or move higher, this is a more conservative approach.
That's right.
Trading Apple. All right. So, CJ.
3 ways.
These kind of words, as we talked about the 3 different ways of taking a bite out of the big apple.
I think we just offered some great flexibility that almost anybody could. I mean, if anybody watching this can take one of those and make them fit with their portfolio. And I love the way it kind of shows the flexibility and the utility of options in many strategies. So, it's
absolutely. Hey, time's up. My watch is telling me it's time to stand up.
oh my gosh, mine did too.
Yeah. Are we synced up? Time to stand.
Time to stand.
I want to thank all of you for watching. Join us next week. We get into October. We'll look at the calendar once again, and we'll see what's going on for the month of October and beyond. All right, folks. So that's it for me and CJ. Have a great weekend. We'll see you again next week. Bye, everyone.
Bye-bye.